Welcome, everyone. Today, I'm going to talk about, interesting slides, digital asset index products and how they can offer exposure to institutions. And especially, I'd like to talk about institutional demand because that's the big elephant in the room now. Because I heard so many times in the last couple of years that institutional demand is coming, but yet I haven't seen data that would back this up. So yeah, my name is Quynh. I'm the Chief Product Officer of CryptoCompare. And before we deep dive into the data, I'd like to give you a bit of a background of what I'm working on and what my mission is. So CryptoCompare is partnering with MVIS, a regulated benchmark index provider, to offer digital asset index products. And as of now, we are managing 30 plus regulated digital asset indices across the globe for our clients in the US, Europe, and Asia. And these indices are disseminated to Bloomberg, Reuters, FactSet, real-time, and end of day as well. You might recognize some of our biggest clients, Nomura Research Institute, NASDAQ, and so on. So it has been quite an exciting journey working with MVIS in the last 3 years. In 2017, they approached us because they were looking for a calculation agent for their digital asset index family. And we started working. We launched the index family in late 2017. And after that, it was a lot of work to talk to clients, develop products. And in late 2018, we acquired our first giant client, NASDAQ. And from there, we've seen a growth of client acquisitions and product development. So I'm very excited about 2020 because I believe that it's the year of product development. Why? Because I think the industry has matured a lot. It learned from its mistakes, and the right product will win the war of attracting institutional demand. This is why we launched a thought leadership series. The first one was just published today, actually last week. And it will serve as kind of a research market overview, but also as product ideas for asset managers and funds. Yeah. So, institutional demand, is it a myth or not? When you look at the press, there are certain types of news you might see that kind of signals institutional sentiment on digital assets. You might see that a non-crypto company acquired a crypto company. Or you might have seen that some brick-and-mortar financial institutions laid the foundations of blockchain. Or some crypto companies started offering institutional services. All of these are positive sentiments, but the better way of assessing demand is to look at what investment products are available currently on the market and how they perform. 2 Bitcoin futures products were launched in regulated exchanges on CME and CBOE in late 2017. And at that time, these products were super exciting because a lot of the Bitcoin ETFs wanted to use them as underlyings. And we will talk about that in a bit. So what you can see on the chart is monthly volumes of these futures products in $1 billion. And you can see that CBOE stopped trading its futures products in 2019, which is a negative sign. It might mean the lack of demand for these products. But nevertheless, the CME futures picked up in 2019. You can see a big spike in January. One reason for that might be because the SEC has approved a fund that wants to hold Bitcoin futures. So there might be more interest picking up. This is an example of another interesting product for institutional clients offered by Grayscale. This is a trust fund where contributors' investment are held in separate accounts, and the product is trading on OTC markets. So Grayscale has reported that only in 2019, they have raised 600 million, out of which 80% was coming from institutional clients. So that's not too bad. Currently, they are managing 2.8 billion assets, USD. Cool. Another way of investing in the blockchain industry is through buying shares in crypto companies. This chart is from Galaxy Digital, and it's showing the M&A deals aggregated over time in the last 10 years for digital asset and blockchain companies. That's the blue bar charts, and the purple ones. And the grayish blue ones are the fintech M&A activity. So you can see that M&A activity is picking up. As of 2018, there was 5.8 billion invested. For 2019, that has gone down to around 4 billion. But you can recognize that the level of M&A activity for digital asset and blockchain is the same as fintech was in 2013. So that's not too bad. And this is the last example of a product I want to show you. These are called blockchain ETFs. They are ETFs, yes, but they select shares from companies that are already listed in regulated exchanges. So you might find in the composition companies like NVIDIA that produces graphic cards for mining equipment. But you can also find quite obscure companies that just are there because they have a blockchain department, like Apple. So clearly, these sort of products are trying to cater for some sort of demand. So I think they signal a demand. But unfortunately, the regulation is not there for these investors to really invest in the digital assets. So I think these products are quite far-fetched from the digital assets, but still clearly show some sort of demand. Altogether, these products make out around 200 million assets. So looking at overall of these different types of assets that are available for institutional clients, what strikes me is the relative proportion of the different types of investments. In traditional markets, what I would expect is that derivatives and funds dominate the investments. But here, it's clearly not the case. And in order to understand this, we would need to look at what investors' preferences are and where is the gap in terms of what's available in the markets. There was an interesting research done by Fidelity last year. They surveyed 400 of their institutional clients, and 22% already own some digital assets, and almost half said that they would be open for investment in the next 5 years. That's quite a lot. And not surprisingly, the most popular investment type is second row, middle one. 72% would buy investment products that hold digital assets. So it's more like an indirect investment, a sort of portfolio that holds digital assets. You can think about ETFs, funds, and so on. But then why is this gap between institutional preference and what you can see in the markets, that the highest value of investments is through M&A, which is quite costly and really not liquid? So we need to talk about 3 key aspects of how investors decide on investment products: exposure, liquidity, and cost. And this can vary in a wide range. In terms of exposure, you've seen that we can differentiate between 3 types. Direct exposure, you hold the asset directly. Indirect exposure, so a portfolio, a fund, and so on, or a kind of ecosystem exposure that the blockchain ETFs try to achieve, or you invest in companies through funds, VC funds, and so on. So if we can believe the Fidelity research, then the most popular way of investing is the middle column, so indirect exposure. But when you look at the product range, they will vary a lot in terms of liquidity and cost. And non-surprisingly, one of the most popular investment types is ETFs, because they have high liquidity, they trade on exchanges, they are more liquid than futures because you don't need to roll, you don't need to hold margin accounts. They're also more liquid than closed-end funds or mutual funds. So it looks like Bitcoin ETFs would be the perfect investment option for institutions. But we all know what happened to the Bitcoin ETFs. Spoiler alert, they have been all rejected by the SEC. But I'd still like to talk about the brief history of ETF filings, because I think we can learn a lot about it, and also from the product perspective, how they evolved over time. This is the brief timeline of the ETF filings. I don't know if you can see the little gray bars showing the start and the end of each proposal. And generally, the main reason for the SEC's rejection was that all proposals failed to prove that they comply with market surveillance requirements and can prevent market manipulation. But let's see how the proposals evolved over time. There were 4 main waves, I would say, and the main differences are in the underlying and the pricing index. So let's look at the first one. It was the Winklevoss one from 2013, very long time ago. That proposal wanted to use physical Bitcoin, and for pricing, it wanted to use the Gemini exchange prices. Back then, the reason for rejection was, of course, market manipulation and issues around the security of custodian service. OK, so learning from this, the second wave changed the underlying from physical Bitcoin to Bitcoin futures. That was the time when CME and CBOE launched their futures products. Great, they thought, this way we can have underlyings on a regulated market that obviously complies with market manipulation requirements. But the SEC said that, unfortunately, these futures markets are not of a significant size, so the price can still be manipulated on other markets. There was a short intermezzo with the third wave with a OTC physical Bitcoin underlying. So what happened there was Vanek and Solidex proposed to use an OTC price index. They were arguing that potentially there is more trading happening on OTC markets, actually. And you can have data sharing agreements with the OTC desk. But they have withdrawn. Then came the last phase, which is, again, proposed to hold physical Bitcoin. But this time, they were trying to convince the SEC that it is very difficult to manipulate the top 10 crypto exchanges for various reasons. But unfortunately, the reasoning was not strong enough. So even though none of the ETF proposals were approved, there are positive implications of all of this. And that is that the whole industry has matured and improved a lot. Regulated exchanges rise, but volumes are still quite low. There are market surveillance technologies that has been evolving. Based on the CryptoCompare benchmark report, 4 out of 10 of the top exchanges use external market surveillance. So these are crypto exchanges. And all top 10 exchanges use either internal or external market surveillance. And lastly, custodian services are going institutional as well. There have been a lot of M&A activity in the custodian industry, and some of them got insurance as well. So yeah, the standards of the industry has been raised. But let's jump now to Europe and see what is happening on the Swiss exchange. Because while the SEC has been rejecting all ETFs, the Swiss exchange became the hotspot for exchange-traded products. So what are exchange-traded products? This is the 6 exchanges definition. ETPs are secured bearer debt securities that do not earn interest. These products are not subject to the Collective Investment Schemes Act, and as such, are not supervised by the FINMA. What does this mean? It means that these products are following an underlying asset's price, so they give investors the exposure that they are expecting, but at the same time, they are not funds like ETFs, so they are not regulated in the same way. Just a few examples of the ETPs on the 6 exchange. We have HODL, a basket of 5 assets from 21 shares, previously Amun, the gray bars. And we have WBTC, which is a Bitcoin ETP from Wisdom Tree. And these are the daily volumes of these assets in USD. So yeah, the markets are slowly picking up. The interesting thing is that a lot more products are being launched on this exchange, and it's definitely worth watching the 6 exchange grow. OK, now I have a little bit of time left to talk about digital asset index products and how we develop them and why they are important. So my point with all this was that I think there is more institutional demand than what we see. And it's because the right products are not there yet to cater for this demand. And I think the solution will be in product development. And one of the ways to give access for digital assets for institutional clients is by providing index products. This is just an example of an index we created for one of our clients, 3iQ. It's a Canadian fund. We help them through the process of building the methodology, backtesting, and so far the Canadian regulator is happy with our work, and they will be launching their exchange-traded product later this year. There are, of course, a lot of challenges when someone wants to launch a digital asset index product. And we are trying to help with our services, especially around corporate events. So how do you handle hard forks as corporate events? We have a full policy on this. And of course, around global exchange liquidity as well, we have a benchmark report that helps you select the right exchanges for your index, for example. Yeah, just a bit about CryptoCompare services and how they all tailored to asset managers' needs. We have market data to provide the index calculation, and of course, we have methodologies and research to implement all the processes you need for an index product. And of course, media like this event today where all our clients can present their products. Just a last slide, just to show off with a range of research that we've been doing, also tailored to service the index products ecosystem. Yeah, so just to wrap up, I think this year will be super exciting in terms of product development. I'm seeing a lot of improvements in terms of how the industry standards has been raised because of the ETF rejections. But there's a lot more to look forward, and the ETP market on the SIX exchange is definitely something we should watch this year. Yeah, thank you.